So coming back to Viceroy, what Vedanta has to say is that all the information that Viceroy is using is already available in public domain, and Viceroy is using select data to sensationalize it. And given they are short sellers, they want to sensationalize this news, and so that investors get into panic selling, and therefore they can benefit out of it. All right. So indeed, they are short sellers, and they will pinpoint such information such that there is panic selling, and so that they can benefit out of it. And so for a moment, let's leave Viceroy's reports aside, and we'll try to look at things in a neutral, unbiased way. All right. So Vedanta stands as the leading producer of zinc and lead. Vedanta is world's second largest producer of integrated zinc. Vedanta is also world's fourth largest silver producers. And Vedanta has India's largest aluminum capacity with 45% market share. And Vedanta is one of the highest dividend payers in the country. Vedanta is one of the highest taxpayers in the country. And net debt to EBITDA, it has reduced from 3.3x in FY 2020. So from 3.3x net debt to EBITDA in FY 20, it reduced to 2x in FY 25, and it further reduced to 1.3x in Q1 of FY 26. And going forward, they want to contain it to below 1. All right, it looks good. And so net debt to EBITDA is expected to be curbed at 1 going forward from the present extended levels. And the company is highly focused on capital expansion in its major segments, which is consistently and significantly increasing, which is a very good thing as it appears, because capacity expansion, business expansion means it will yield at some good results at some point in time, right? So because expansion of capacities across segments will lead to increase in cash flows as well in future, some brokerages have projected that they can earn cash flows up to 35,000 crores going forward because of these capital expansions, capacity expansions, which is a very good thing. But the past year records that we've seen, Vedanta does not create so much cash flows, or Vedanta does not have enough profits that it can comfortably pay such massive amounts as dividends. So if at all you're having to borrow such amounts to pay as dividends, why? I mean, when you don't have so much cash flows, why do you want to pay like 261%, 151% FCF cash flow? What is the requirement? And if you're having to borrow it, why? Another issue is when you don't have enough cash, enough profits to distribute dividends in the first place, and you're having to borrow for it, where do you get funds? Where from do you get funds from for capex? Because you show that you're consistently investing in capex, right? And if at all you're having to borrow and invest in capex, given you're a diversified natural resources company, why borrow to pay dividends, to pay such massive dividends, out of which you take back 57%, right? So perhaps one way of looking at it is going by what Viceroy says, that is, extract whatever you can from Vedanta Limited and other subsidiaries, send them to the parent Vedanta Resources in the form of dividend or brand fees or whatever, and use it to reduce the parent company's debt and to finance their expenses. This is one way of looking at it. The second way of looking at it is extract whatever you can from subsidiaries, send it to parent Vedanta Resources, so that at a future point of time, when, if at all, they declare they do not have enough funds to repay debts, the burden of such debts is passed on to the lenders, creditors, regulatory bodies, and investors. Vedanta Group will be safe. That is one way of looking at it, correct? Now, another important set of issues that if you see, is your stake sales. Okay, so I'll explain one by one whatever information I've been able to gather. So $700 million, that is around 6,127 crores. To such extent, debt was reduced in FY 25, and this was financed by raising $1 billion, that is around 9,000 crores through the QIP route, and $400 million, that is around 3,500 crores by Hindustan Zinc stake sale. They're having to raise funds through QIP route and by making stake sales to reduce debt. All right. But two interim dividends of FY 26 equals to 9,000 crores. So why raise funds of 9,000 crores to reduce debt, and why make such massive interim dividend payments of 9,000 crores within just two interim dividends? What is the rationale? Out of which you take back 56%. All right. So in another news report, the stake sale of 1.5% in Hindustan Zinc in July 2025 for rupees 3,028 crores is to reduce debt. And so let's see what Harshal Dasani of INV Asset PMS has to say. So Harshal Dasani, business head INV Asset Portfolio Management Services, said that Vedanta's management of Hindustan Zinc highlights critical nuances in corporate finance and capital allocation, particularly regarding dividend policies and debt management. Over the past 5 years, Hindustan Zinc has seen a substantial decrease in its reserves. From 39,465 crore rupees in March 2020, it is down to 12,445 crore rupees by March 2025, marking a considerable reduction of 27,020 crores rupees. And concurrently, borrowings of Hindustan Zinc have notably risen, increasing from just 611 crore rupees in March 2020 to 10,964 crore rupees by March 2025. So borrowings of Hindustan Zinc over the 5-year period 2020 to 2025 has increased from 611 crores to 10,964 crore rupees, signifying an increasing of rupees 10,353 crore rupees within this short span. So if you see a news in August 2023, promoter entity Twin Star, it sells 4.1% stake in Vedanta for around rupees 4,000 crore rupees. So billionaire Anil Agarwal promoted Twin Star Holding divested a 4.1% stake in Vedanta Limited for 3,983 crore rupees. So if you see in 2024, Finsider International Company, that is Vedanta Resources promoter company, that sold 1.8% stake for rupees 1737 crores. This was in Feb 2024. So in Feb 2024, Finsider International Company, that is Vedanta's promoter group, that sold 1.8% stake for 1737 crore rupees. And the balance stake that it had in Vedanta, that is 2.6% stake, was the balance that it had left in Vedanta's group, that it sold in June 2024, amounting to rupees 4181 crore rupees. So in 2024, in two different transactions, in February and June of 2024, the promoter company of Vedanta Resources, by the name Finsider International Company, sold its entire stake in Vedanta. Alright, this amounts to roughly 6,000 crore rupees, 5,921 crore rupees to be precise. And the reason that was given as to why was to reduce debts. Okay. Now this news is from May 2023. So Glencore lent $250 million to Vedanta Resources, the holding company of the Vedanta Group. The loan was pledged against 4.4% stake in Vedanta Limited, the Indian listed subsidiary of Vedanta Resources. What they kept in the form of pledge is Vedanta Limited's shares to get loan for Vedanta Resources, amounting to $250 million from Glencore. So this is a report from August 2024. In a more recent move, the India-listed entity raised 8,500 crore through the qualified institutional placement route. The company's executive noted that this will be further instrumental in deleveraging the balance sheet and reducing finance cost. So, in August 2024, 8,500 crore rupees was raised through the QIP route. So, in another report, if you see, as of June 26, 2024, as much as 4.6% equity stake in Vedanta Limited was sold for rupees 7,485 crores in block deals on June 26th, with a promoter entity being the likely seller. Alright, and this stake sale in Vedanta Limited comes days after the group chairman Anil Agarwal said that the promoters wouldn't dilute any more equity in the company. So in another instance, parent firm Vedanta Resources denied a report to sell shareholding. Alright, so around 5% equity stake sold in a block deal in June 2024, with promoter entity being likely seller. So as of June 2024, if you see, Vedanta was in talks to sell up to 30% stake in Konkola Copper Mines to a subsidiary of United Arab Emirates International Holding Company. And then a news came in Feb 2025 that Vedanta Resources initiated discussions with global investors, including Glencore, to sell some stake in Konkola copper mines, seeking to raise $1 billion debt. So, had we come across just this series of stake sales, it would have meant that the company is in a massive debt reduction program, and that it is borrowing funds, it is raising funds, it is making stake sales so that it can reduce debts. Okay. But when you're having to sell your stakes frequently through various means, and that also very frequently, why are you paying so much dividends? And that also when you're not generating so much profits and cash flows is the question, right? Upon that, you're investing in capex. Are you borrowing for that since you're not having enough cash flows and profits? And if you're having to borrowing for that, why such massive dividends, right? Now, even if the company comes forward and says that we are borrowing debts for capacity expansion, for capex funding, and to reduce debts, even then they'll have to answer why so much dividends when you're not making so much profits and cash flows.